what I've seen change is that we have a lot of partners who want to grow, but the pricing has been affected by the institutional buyer. I've never seen cap rates anywhere near this level. Even in 2007, they weren't this level. I think that's been the biggest change, is the institutional buyer entering our space.
And well, there's a couple things going on in the competitive environment. First of all, there's obviously a lot more activity. And then we have the advent of a couple of new brands. And so as a result, the developers have a wider array of choices between some very established brands and some newer brands. Cambria Hotels and Suites is ours, particularly in the upscale. And that's really where the new construction is occurring in upscale. So competition is fierce. The financing environment is improving significantly. So there is more money to develop. So you're starting to see the flow of a lot of new projects. But the success of those projects rides on one simple thing. If you build it for the right price, usually you can figure out the demand in the consumer segment as long as you're picking good locations. And as a result, the deals are made or lost, and partners' returns are made or lost in the construction phase. The only second most important aspect of a hotel development beyond that construction phase is the ramp-up phase. If you don't ramp up relatively quickly, you will lose those early year returns and therefore water down your return on investment. If you do those two things well, you're going to be successful, and it's a question of how successful, and that's simply based on the market and timing. Right now, for developers, the timing looks really good because we're looking into a 2 to 3 year cycle up still. And so if you can get your hotel open in the next 12 to 18 months, you're going to have 2 to 3 years to have a wind at your back to get stabilized before starting to think about the next cycle. So it's a pretty good time to build, and our folks are beginning to build in significant numbers. But even with that, we don't expect any serious supply additions till 16, 17.
Competitively speaking, the world has changed a lot in the last year, and that's because the availability of debt and equity capital are more available than I've seen since 2007. So many new projects are underway. Lenders are fast to say, we will finance you. Developers, especially those that are not that seasoned, are doing some of their first new hotel transactions with aggressiveness, whereas 2 years ago, we as a company have a history of development. We're often the only developer of a new branded hotel in a marketplace. By example, today we have 14 hotels under construction in 14 different markets. 2 years ago, we thought we were about the only one that were going to build those hotels. We are shocked in some markets where we see 5 or 6 coming up with us.
The competitive set so far has not changed, or the competitive landscape has not changed recently. Though there is some fear and worry that with the liquidity market and the financing out there with some of the local banks, we're hearing a lot more stuff coming in the market as far as new hotels. Plus with the new brands that are out there, a lot more opportunities for people to develop hotels.
The developer's ability to economically justify new construction in one sense has become easier over the past year or two because the industry fundamentals continue to strengthen, i.e. occupancies, room rates are going up, profits are growing, all the things you need to see to comfortably make what's clearly a significant capital commitment to building a new hotel. More and more lenders, which is obviously a critical component of the development process, more and more lenders are becoming comfortable with making commitments to hotel developers. Although, that's certainly a good sign. But we're still a far cry from what we saw during this period of the previous cycle, where the amount of equity required, the terms surrounding that equity requirement, were much more borrower-friendly back then than what we're seeing today. So it's moving in the right direction, but it's a very slow process.
The competitive landscape it's become much more aggressive. It's definitely there's a lot more companies looking to get into every market. The good thing is the financing has opened up, and so the valuations have gone up in many of these markets where we're now at the point where that inflection point where the replacement cost is less than the valuation. So so you're seeing a lot of these projects, a lot of people looking to get into projects, and obviously there's a lot of competition for those developers. So it's changed. It's a much more mature industry. You're seeing a lot of the hotel companies now. It's not just networking and out there talking to customers. You're actually out there studying markets, finding sites, doing the due diligence, and actually bringing the projects to the customers, which I think is actually good for everybody.
The competitive landscape has changed in the last several years due to the extraordinary availability of capital and the willingness of the various brands to expand their footprints in various markets across the United States.
The competitive landscape has changed in hospitality over the past 24 months due to the proliferation of liquidity from banks for new construction and development projects, not only in hospitality but across all facets of commercial real estate asset classes. In first-tier markets or primary markets, we're seeing land and construction costs really accelerate. So it's making the development a lot more challenging, tougher to have things pencil out, and lenders are seeing that and pulling back a little bit. So we're really focusing our development efforts on either secondary markets or in more niche opportunities in the primary markets, for example, as part of a mixed-use development.